U.S. job gains slow in January, but the unemployment rate falls to an 8-month low. The non-farm payrolls report from the Labor Department was a mixed bag, and stocks fell after the report's release. Here to break it all down for us is George Cipolloni of Penn Mutual Asset Management. George, January's job gains were 143,000, and they were significantly less than the job gains that we saw in November and December, which were actually revised even higher with this report. So what's behind the big gap down?
So, Lisa, I think what's even more important than the gap down, quite frankly, has been the average over the last few months. So those revisions were really critical. And the reason is that we've seen, so if you look at the average, because we know these revisions have been pretty big over the past few years, quite frankly. What the market is focused on, I think, in terms of how they took the report, is the fact that that average creeped up to about 240,000. And that's a pretty big number, up from 165,000 as an average over the trailing 3 months. So it does indicate, and I think the Fed is going to take this like maybe we are at full employment and maybe we don't have to cut anytime soon.
President Trump is slashing thousands of federal jobs, and of course, his policy on deporting migrants and tariffs could also tighten the labor supply. How do you anticipate that his policies may affect the jobs report going forward?
Yeah, so if you think about this is a really important question, and I think the market and company managers, quite frankly, if you listen to Amazon CEO or Ford CEO, everyone today is trying to digest what his policy is going to mean. So let's just take the job market for example. If you look at the bucket of government jobs, if you look at the bucket of non-US or immigrant jobs, those were really strong and supported our jobs numbers overall for the last few years. So if you take those two buckets away, or at least reduce them, you could see some pressure on that jobs number moving forward and maybe even unemployment moving up a little bit. So I think, again, that's another different wave that we may not see or anticipate as we go throughout the year, but that's one that we're going to have to be mindful of for sure.
So you think that'll take some time then to work its way through the system and wouldn't perhaps show up and make the Fed cut rates even sooner, which is actually what President Trump wants, correct?
Correct. So obviously Trump wants lower rates. I do think Scott Bessent gave a really important interview yesterday. And one of the big takeaways that we've had is that Trump, during his first administration, was very much focused on the Fed and Fed rates. And he beat Powell up pretty good in terms of whether or not he would raise rates or cut rates. I think Bessent has tried to move Trump off point to focus more now on the 10-year yield, which I would agree is more important. I think that 10-year yield is the one to watch, and it's the one that Trump really should be focused on. And there's ways to manage around that, although it is purely a market-driven rate. So there are some things that they can do, and a little bit of this uncertainty will obviously impact rates as it is today. So I think, again, the tug of war is going to be ultimately whether the pro-growth strategies that Trump wants to employ, whether these tariffs and the uncertainty that gets placed into the markets, how does that jive or correlate with lower rates? And at the moment, it's not.
And do you see the importance of the 10-year mostly because of interest rates or their effect on stocks or both?
So both for sure. So I think the 10-year yield is obviously the benchmark rate. It's extremely important for just about any asset pricing. And if you think about, so now where we are in terms of the level of rates, I think is really important to the stock market. And we can see it and feel it from a sensitivity standpoint on a day-to-day basis. I think from 4 to 4.5%, the stock market is not as sensitive to interest rate moves as it is from now. We're around that 4.5% rate range. And if we go up to 5%, and anytime we creep up to 5%, it tends to be problematic for the stock market. Things start to get a little more volatile. We start to see a little more downside. And I think that's really a key area to watch for now. And today is a perfect example of that.
Trump announced today that more tariffs would be coming on our trading partners next week. He did not say which countries those are going to be. Now, he says that this will help offset his tax cuts, which he's hoping that Congress will extend, and shrink the budget deficit. What do you make of his proposal?
It's a pretty radical proposal in regard to now. Now, look, Trump said that tariffs is his favorite word. He said that while he was campaigning, so this shouldn't be much of a surprise. And we also have some precedent with his first administration or his first run in the White House. So, but what I am listening to now is number one, there's uncertainty in the market, and the market does get swung around on a day-to-day basis based upon what he is saying, based off of whether he's negotiating and companies back off or different proposals. But I think what is really important is to listen to company managers. And Ford's CEO Jim Farley came out this week and he said, if these tariffs are implemented and if they are implemented for an extended period of time, this will wipe out our profits. And I think that's a really important data point to focus on. It's something that's important to listen to. And I certainly hope the administration is listening to those types of comments.